All right, so we're starting our session for today, and we were discussing this trading system. So just once again, every session I'm quickly anchoring you into where we are. I will not start from that far back because we have the videos for the previous sessions. So we are essentially trying to solve, trying to give you ways in the larger sense. We are trying to give you frameworks, theoretical framework for solving all the major decision problems that arise, as well as the sub-decision problems. And that's what we are trying to discuss in sequence, sometimes flipping around from here to here, here to there. So we were in the process of doing this. We were actually looking at, if you look at your Calc 5, we were actually we had gone through some discussion of value versus price on the one hand and the TA paradigm. And now we are in the TA paradigm and we are trying to evolve a TA system, and that's why we are over here. A simple trading system using technical analysis, and so that you can do your project as smoothly as possible, given the fact that you're quite new to all this. And actually the decision problems involved in the project are quite complicated. So this is where we are. We are right now we are in this other side of the tree, on the right-hand side, the TA. And within that, we are using a more or less mechanical trading system. We'll get into the details of this later. So that's where we are, and that's how we came to be discussing. We are trying to cover these decision problems, and we are discussing a trading system. All right. So first, I should have defined the trading system in the previous class. A trading system, I might have mentioned it orally and not put it into the notes. That's why you need to listen to the full session, and because I'm not able to put everything into the notes, and it also slows me down. The more I have to write, the more it slows me down. But I try to write as much as possible. Okay, so what is a trading system? If you want to think about a trading system, the way we talk about it, it's a set of preferably objective rules. Objective rules means objective, not subjective. Okay, so objective rules would be, say, for instance, if I tell you that if I'm leaving the room and I'm giving you instructions and I'm saying, okay, every time the temperature falls below, if every time the temperature falls below, say, 15 Celsius, switch off the AC. Now that's an objective rule. Okay, everybody will follow it in exactly the same way. But if I say every time it gets, quite cold, switch off the AC. Now that's not an objective rule, because what's quite cold? Quite cold can be different for different people. So that's a subjective rule. Okay, if I say quite cold. So in general, when we have a trading system, when we talk about trading system, we want to preferably have objective. The reason I've written preferably objective is you can't have a 100% objective trading system. There is a certain element of subjectivity that always comes in. So we try to be as objective as possible. A set of preferably objective rules for solving all of the DPs that arise. Okay. So DPs are decision problems that you should be already familiar with this abbreviation by now. Okay, that arise, okay, in the management of an investment fund, which is what you guys are doing right now. Okay, an investment fund, and we are actually later on. This is actually in generic terms. This is called a active risk book. We will discuss this later, what is an active risk book and what is a passive risk book. But for the moment, you can understand an investment fund is an example of an active risk book, and that's what you're managing. So when we say trading system, what we're talking about is preferably objective rules, okay? So I'm going to highlight objective rules, solving all of the DPs. Okay, which means that the problems that you're facing in your own project right now, which is that you have to solve all of these problems. Some I have already solved for you, but on a regular basis, you have to solve the rest of the problems. And you need to have, if you have a trading system, you would have had, you would have created a set of rules which allow you to solve these problems. Okay, so that's what we are designing right now. And we have covered some of the material already. We had some discussions. Now, what we are trying to do here is...
Hello, sir.
Yes.
Sir, Vipul this side. Sir, I joined late because, sir, there is a power cut in my area.
That's okay, fine.
Yes, sir.
All right, okay. So, right. So what we are doing is we had the discussions in the previous classes. So I think where we finished off in the last classes, we had a long discussion on some of the properties of cycles. So we moved into the discussion of the cyclicality. We had this discussion on cyclicality and looked at, especially the last two, the specific definitions of uptrends and downtrends, and what are the minimum conditions for starting and maintaining uptrends and downtrends, and what are the implications for that. So I have tried to document that in your notes. I've tried to keep a little bit better track of, because the session notes really is a kind of a tracker for us, for all of us, both you and me, which is just to figure out basically what are the topics we covered in the last class, just shorthand bullet point format. So this is what we covered. We covered some of these points, okay, and then we discussed about trailing stops. So we will continue today, and we will make sure that we try to cover as many of these decision problems as possible. So this is where we are. We are trying to define for ourselves a simple technical trading system, which will help us to solve all these DPs. Okay. Now, one of the things we are going to do is we are going to try and define a, you can put it here. We'll define a, okay, let me just put it here today initially, and then I will. So what I want to first talk about is a minimalistic trading system. Okay, a minimalistic trading system. Minimalistic means very, very simple, having only the bare minimum elements. Okay, as simple as possible to get the job done. Okay, so in general, these kind of minimalistic systems, a bare bones system, these are very good because they strip it down to the absolute bare essentials. So that's going to be one of our foci for the next few sessions. So when we look at these decision problems, okay, these fonts are big enough for you guys to read. Harsh, are you?
Yes.
The fonts are the decision problems?
Yes, sir.
Okay, all right, okay. So, all right, so so therefore, now what you notice, I've put some colors in here. These are the three most important decision problems. And if you look at these decision problems, the first three, asset class, market, and instrument, this I have already solved for you, all right? So this is not, so all these problems are not equal in terms of importance, because these usually get solved by the investor mandate, and you don't have to solve them every time, okay? Notice that, you know, I've given you a list of markets, so therefore you don't have to solve this problem on a daily basis, right? You have your list of tickers, and that's all you've got to look at for this project. So you don't have to, so these first three problems are a little bit different from the rest because they are usually solved by the investor mandate. So the investor tells you, here's my money, and this is where you got to focus on, and don't go anywhere else. And these things don't have to be solved on a regular basis. So we forget about these for now because we've already solved it. I've solved it for you. Now, among the ones that remain, all right, we have so 5 more problems that remain, major problems. Of course, there are sub problems within each of these, but the major problems that remain, again, I've here put in some kind of a hierarchy here. These 3, 4, 6.2, and 7 are actually more important than these two, which means that I can design a trading system, which actually is a minimalistic trading system. And so therefore, we will not need to worry about solving 5 and 6.1. Okay, I will show you how that works. And we are going to first And so if you do this kind of a trading system, that will give you a very good understanding, a quick understanding of a complete trading system. And at the same time, it will be a minimalistic trading system. We will avoid having to deal with the additional two problems. And then we will deal with them later, all right? So let's look at this first. Now, if we have a minimalistic trading system, we have solutions to only these. And later on, I think what I will do is, I will put it later on into the trading system notes. Right? So what we are trying to show here is that we are only solving this DP4, the DP 6.2, and so it's a quick and dirty way of showing that this is all we are trying to solve in the minimalistic trading system. Okay, so let's see how this works. Now we'll just start quickly running through, going back through the DP4. Okay, we are already using a two time frame trading system, and one of the things we discussed in the previous class is why two time frames. All right, and as we have this rule, so you have to have the same trend on both the time frames in order to be able to trade. So if we take any of the tickers, now you have to let's take any of the tickers that you have. Right. So if we take, let's say Ford Motor, okay. Okay, so we have Ford Motor. Let's have, I'm just going to use my time frame. Sorry, it's 1 year and 3 months. So I see that the 1 year trend is down. Okay. So I'm trying to now quickly run through how to decide how to solve these decision problems. We've already solved these three, and I'm saying that these 5 and 6.1 are not really essential. You can forget about these problems or solve them in a mechanical way, and therefore you really need to focus on the remaining 5. You have to only focus on these 3. And how do we do these? So let's look at buy sell. First, how do I decide my buy sell bias? Right. So that's what we're trying to show you. So Ford Motor, for that buy sell bias decision, I'm going to take the framework that I've given you here, which is your first two time frames, and only if the direction is the same on both the time frames, then you trade in that direction. Okay. So here we have 1 year Ford Motor. This is a 1 year chart. Yeah. So the 1 year trend is down, as you can see. Then what's happening to the 3 month trend? That's up. Now, so this is a little bit confusing for us now because we can't do anything at this point because the 1 year trend is not consistent with the 3 month trend. Okay. So from a momentum point of view, let's do it this way. That if we see what I have written here. So what we have, okay, all right. So let me see the distinction. Okay, so let's say the DP4 solution. Okay, momentum. And so we're as a momentum. So when I say momentum, I'm talking about a momentum trader, and then we will also talk about a mean reversion trader. All right. So remember that when we are talking about these two time frames, if I give you a better picture, we can't do US stocks on this, but this is the ideal kind of chart display that I told you guys about. Okay, which is this is showing you crude oil prices. West Texas Intermediate crude oil prices. So the ideal way to look at do technical analysis is to look at this kind of a chart display, where you're going from maximum zoom out to maximum zoom in on this side, and this is how you move. All right. So if you, let's say for instance, if my approach is, if my two time frames, I'm just using a simple two time frame system. If my two time frame system is this one, the monthly chart, and I leave out this one and I go to the weekly chart. Okay, so I have a monthly chart time frame view, and I have, so this is my big picture, is small picture. Okay, big picture and small, big picture, small picture. So if these are the two time frames that I'm using, so what we are doing is, here we are discussing momentum traders. Okay, so how are we going to solve this? Right. So if I see the long-term trend, it's down on the big picture. And if I look at the short-term trend, it's also down. All right. So I can actually go short over here as a momentum trader. 1 minute. Let me just make sure that all the participants are visible to me in case anybody's coming in there. All right. One more thing I must mention quickly, guys. I'm noticing some of you guys are, because I'm marking your attendance based on your the Zoom attendance log. So because of all the technical problems and things like that, I'm giving you a lot of leeway this time. But unlike the real class where you have no leeway at all, you have to come within 5 minutes or 10 minutes. So please make sure that you, because I'm noticing some of the students are spending very little time in the class. In those cases, I'm marking them absent. I'm not going to tell you what my cutoff is, because then everybody will start gaming that cutoff. So you need to make sure that your behavior is pretty much close to what it would be in the actual physical class, where you would not get any leeway at all. This time I'm giving you some leeway, but don't exploit that leeway, because I'm having to mark people absent who have very little time spent in the class. All right. So so here's my time frame. Here's my momentum approach in a long-term, in a two time frame system. And I'm showing you the example with respect to crude oil, but everything is the same. When you're using TA, all the asset classes are the same, whether it's commodities, equities, the approach is all the same. All right. So here you have the long-term trend. I see it's down. The short-term trend is also down. So what I can do is I can straight away, my buy-sell bias decision is easily made. My buy-sell bias decision is quite easily made as a the decision on DP4 solution. Okay, momentum. So two trend time frames. Let's look at. Okay, use two time frames. And as we said, we are just repeating some of this stuff over here so that we figure out, we are clear about how we are solving this problem. Okay? Trend is both, is the same on both sides, then you trade. As a momentum trader, the decision is very easy on this. Okay, long-term trend down, big picture down, small picture down. Now, so my DP4 is basically a decision on what should be my buy-sell bias, right? DP4 is a decision on buy-sell bias. So therefore, here what we are not talking about the entry price, which is a separate decision. Okay, so as far as this is concerned, this is quite clearly decided for me. Okay, because the long-term big picture is down and the small picture is down. In comparison, when you look at Ford Motor, the picture is not clear because the 3-month trend is up, but the 1 year, as we saw, is down. So they're not pointing in the same direction. So in terms of Ford, I can't, as a momentum trader, I cannot actually come out with a decision. Okay? Even as a mean reversion trader, I can't come out in the same with a clear-cut decision. And let me actually make this rule only for momentum. Okay. Let me make this rule for momentum. Okay.
Excuse me, sir.
Yeah.
So actually, Kanaka is facing some network issues, so she's trying to reconnect again.
Okay. All right. Okay. Is she in the? She's not in the waiting room, right? I don't see anybody in the waiting room.
I'll have to check, sir. She was saying she's trying to rejoin.
All right. Okay. No problem. So. Okay, so here we see, look at, so what was I saying? Okay, so this rule that I've given you, we will keep this initially only for the momentum philosophy. And when it comes to mean reversion, we will say, I just want to avoid writing this big word. I'm just going to copy this, okay, and say here. So these are the important rules, okay, for mean reversion philosophy. The slightly different rule, okay. This part is very important because here we're defining how to apply, because these are the only two philosophies they will typically have, okay, in when you're using TA, or even if you're using FA, actually, you'll see that most investment approaches fall into one of these two. Either it's mean reversion or it's momentum. So when you're looking at these two, what should be your trading rules? In the case of momentum, we have already defined it. It's pretty clear. And we have already discussed and explained it many times. So as a momentum trader, when I am looking at Ford Motor, I am unable to I'm unable to solve my DP4, which is the buy sell bias, because my big picture is down, but my small picture is up, the trend. So they are not pointing in the same direction. So according to this rule, I am not able to trade, okay, under the momentum philosophy. Now, in the mean reversion philosophy, we changed the rule a little bit, okay? We changed the rule slightly. What we are saying is they don't have to be pointing in the same direction. Trend on both time frames should not be contradictory. Okay. All right. Trend on both time frames should not be contradictory. In the contradictory means this. Let me explain this also, so that we are able to document that is contradictory. What is contradictory? I'm trying to explain what contradictory is. So let me just put this here. Contradictory means that big picture trend equal to up and small picture trend equal to down. Okay, that's just one example. Okay? So in the sense that they're pointing in two different directions, which is what you see in Ford Motor. The small picture 3-month trend in Ford Motor is up, okay, because the high is made later than the low. But when you look at the big picture trend 1 year in Ford Motor, it's down. Okay, so big picture down, small picture up. They're pointing in different directions. So this is what we call contradictory. All right. So what we are saying is we are defining, and remember one more thing, that when I've given you these two time frames, when I've given you these two time frames, this is just to give you some guidance, or let us just say this is just to introduce the idea of two time frames. As an example,
Sir?
yeah,
So basically, if in small picture, if we are seeing, if in small picture it is going high, but in big picture it is going down,
yeah.
then we should not trade, correct?
Yes, so it is basically, that's a rule that we are strictly speaking, that's the momentum rule, okay? We are going to define a slightly different rule for mean reversion, but for momentum, what you have stated is correct. It can also be the other way, right? That means the big picture can be up, small picture can be down, even.
And since we are technically doing it in a small picture, very small picture, hence, again, that can be an issue.
Yeah, so anytime they are pointing in different directions, when we are discussing the momentum rule, what we are discussing is, what we are saying is, only if trend on both time frames is same. So it could be down on both time frames, or it could be up on both time frames. That's fine. Okay, so that's what we are saying. So in the sense here, you see what you described just now, what you said just now is you're describing the Ford Motor situation. Small picture trend is up, okay, and you see this trend has not been neutralized. Okay, this trend is up, and you have low, higher low, high, higher high. Highest low from which a new high was made, this one, has not been broken. So this uptrend which has developed on the 3-month chart, that has not been neutralized. So 3-month chart is showing you an uptrend, 1-year chart is showing you a downtrend. So this is what we call contradictory signals. Okay, so as a momentum trader, you can't do anything here. You can't trade here. Okay, so is this clear, Shaurya?
Yes, sir.
And it could be the other way also. It could be that 3-month is down, but 1 year is up. So that would also create a problem. Same problem. You can't do anything. Okay, because they're not pointing in the same direction. Now, as I was saying, this time frame that we are discussing, 1 year, 3 months. Yes.
Sachin this side. Sir, if we want to do an intraday, for example,
Yeah.
so what we consider in this?
Yeah, I'm just coming to that. Actually, you're talking about the time frame. So as when I gave you this 1 year and 3 month, this is just as an example, okay? Because I wanted to just introduce you to the idea of two time frames, because we are teaching you about two time frames, so that the advantage of having two time frames is that we end up treating this DP4 as a separate decision from the DP5. That is, what should be my buying selling bias and what should be my entry price. We treat these as separate problems, and that's one of the reasons why we want to have the idea of two time frames. Okay, there are other reasons also, because you want to trade in the direction of the larger trend. Okay, if you see a big picture trend, if you see here, you see a big picture trend 5-year chart of Ford Motor, you see it's going down, right? So you don't want to be because remember that other principle that we discussed in your cyclicality, that smaller cycles are constrained by larger cycles. This we explained in the last session. Okay, so if the larger trend in Ford Motor is down, okay, then the larger cycle is exerting a downward pressure because the trend is still down here. So it is unlikely that the smaller cycle, at this point, we don't assume, until it actually happens, we don't assume, especially if you are a momentum trader, we don't assume that it's now going to start going up and up, go all the way up to here. We give deference to the longer term trend, the big picture, and therefore that's another reason why we want to use two time frames, is that we want to trade in the direction of the larger trend. Okay, so this gives us the kind of like an overlay or a filter, the longer term filter, big picture filter, but we are always trading on the small picture. Okay, and that's one of the reasons why. So as coming to Sachin's question, I discussed 1 year and 3 months. I just gave you just examples as 2 time frames, but mainly to introduce you to the idea of 2 time frames, okay, and get into this habit of at least 2 time frames. As I showed you here, you can have multiple time frames. You can design even more complex trading systems with multiple time frames to solve your DP4 problem. Okay, but we are not going to get into that. 2 time frames is good enough for us because it introduces us to the idea that you have to trade in the direction of the larger trend, the bigger trend. Okay, and so you have to use the small pattern, the small picture, to get into the market, but where the direction in which you want to get into the market should be driven by the big picture. That's the basic idea. Just to introduce that idea, I put to make you adhere to that principle.
Sir, can you repeat the last part?
Yeah. So what I'm saying is that the reason I introduced the 2 time frame system is ideally you can expand the 2 time frame to use multiple time frames as you have here, but that will make it very complicated for the initial discussion. But if you have 2 time frames, that already takes care of this important principle that when you are trading, you want to be trading in the direction of the larger trend. Okay, you don't want to get caught up. Like I'll give you another example. If you see, for instance, let's say maybe Facebook. Yeah, see now Facebook, if you look at all, now it has been going up, okay, over time it's been going up. This is the time of the IPO, all right? And now if you see, what I mean by the larger trend is that if you were caught somewhere here, for instance, okay, you don't want to be caught by the short-term movement here. You see that it's going down and you start selling. You really have to be mindful of the larger picture. You see there's a long-term uptrend. Okay, so there is actually, this was only a correction. So in this, when you're somewhere here, okay, or when this has gone up, actually this high is higher than this high, right? And this low is higher than this low. So actually this, if you look at 1 up, 2 down, 1 up, 2 down, like that, this is an uptrend in this time frame. In this kind of a zoom, this is an uptrend. So when you are here, you want to be thinking about the big picture, or when you are here, you want to be thinking about the big picture, that there is an uptrend which has not been broken. Okay, this had not been broken. So that's why you want to trade in the direction of the larger trend, so that you don't get caught up in the short-term movement, because there's not much money to be made here by going short, okay, or here. The money is to be made in the direction of the larger trend. Okay, that's what I'm trying to say here. Okay, so does that clarify what I'm saying, Shaurya?
Yes, to a certain extent, but the thing is that how, like at the end, we would not know that if it is going up or down, up or down, right?
Okay, that's fine. That is where you come up with these philosophies. You have a certain type of bias. Okay, I'm still not finished with answering Sachin's question about time frame. I'm coming to that, but I'm just answering Shaurya's question in between. Where see, if you are a momentum trader, remember initially we are discussing from a momentum time perspective. Okay, if you are a momentum trader, I understand your question. Yeah, and you will never know. That way, you will see in this business you are never going to know. All right. Unlike a sort of a hurricane, or when the sun is going to rise tomorrow, these things we can make precise forecasts, and generally we are not, the hurricane is not so precise in terms of forecasting accuracy, but sunrise tomorrow in New Delhi, we can predict the time, okay, and it will be correct. So this is not that kind of business. Here you will never know for sure what's going to happen. No matter what you do, no matter how fancy your calculation, you are never going to know. So you need to make,
Hello, sir.
okay?
Yes.
Yeah. So as a momentum, so how do you make those assumptions? One of the ways you do it is if you decide what kind of philosophy you want to follow. Do you want to be a momentum trader or a mean reversion trader? What do you believe? Okay, what is more comfortable for you? And then accordingly, if you are a momentum trader, so coming back to Shaurya's question, you will never know actually. Technically, you're correct that when you're over here, you don't actually know whether this is going to break or not. When it is falling like this, you don't actually know if this is going to break. But
Somewhat of a stop order according to the variation would be applied more or less.
what would be
That
applied?
stop order.
Yeah, stop order would be applied if you're met, but before that, I'm coming to your stop order is for 6.2. Okay, right now we are talking about DP4 because your question was basically that we are never going to know, right, what is going
Yes,
to
sir.
happen, right? So your DP4 is based on the question of what do you think is going to happen where do you think the price is going, up or down? So now, as far as that is concerned, you are never going to actually know for sure, unlike a prediction of sunrise or sunset, where you will know for sure. Here, you will never know for sure. So what you do is you make certain assumptions. You figure out if you want to be a momentum trader or a mean reversion trader. If you're a momentum trader, then what you do is when you see an uptrend which has not been broken. So as a momentum trader here, okay, what is he seeing? He's seeing a big picture. If we just say he's focusing on this degree of zoom, okay, he looks at all the way up, low, high, now coming down, but this low is not yet broken. So he sees that there is an uptrend. Because
Yes,
the
sir.
trader will always presume that the uptrend will continue, the trend will continue in the same direction. So as a momentum trader, he's going to assume that this uptrend will continue higher. Now that assumption may turn out to be wrong, but you need to do something in life, okay? So because there's uncertainty, but you still need to take a decision. So
Yes, sir.
the decision you assume, because you're a momentum trader, you assume that this uptrend will continue. So here you decide to buy. And then comes the answer, then comes the next point you made. You decide to buy here. So you put your stop over here. Okay, because at this point, I'm just showing you the white cursor thing here. So this is going to be the point, because once it breaks this, then the uptrend is destroyed. And you no longer have a justification for remaining long. But as a momentum, so this is how you solve your buy sell DP4. And then as far as 6.2 is concerned, you put it here. Okay, right? Is this clear now? Sorry, your doubts are cleared?
Sir, more or less, I got the fact that that at the end, since we are seeing that it is not that much of a downtrend from previous one, hence we can keep on seeing because overall an upper trend is going on. So it is safe to stay invested for the time being.
Yeah, this is only if you're remember this is only if you're a momentum trader. So
Momentum.
when you're talking about not that much of a downtrend, I presume you're talking about this one, right?
Yes, sir.
So here the principle that so the way the language that you're using is not sufficiently theoretical and formal that the kind of language we should be using now. Okay, that the point that you're going to make is that I want to trade, the way you should be saying what you said is that I want to trade in the direction of the larger trend. Okay, and here the larger trend, that's why I look at the big picture. The larger trend is up. Okay,
Yes, sir.
as a momentum trader, I want to trade in the direction of the larger trend. So when this is coming down, but the larger trend is not destroyed, I assume that the larger trend will remain in place and continue in the same direction. Okay, so that's why I will go in here and buy. That's why. So this is how you should state this logic. Okay, not in the way that you stated it exactly, not those kind of words. All right, is this clear?
Okay, sir. Yes, sir. I should trade according to the big picture. That's what I should have said, right, sir?
Yeah. So that's what, because this is where the big moves are coming, right? So, and the smaller picture is constrained by the bigger picture, as you can see.
Yes, sir.
As long as the big picture remains in place, the smaller picture is constrained by the bigger picture. Because there's a longer uptrend, this downtrend which happened, it could not break below this low because the uptrend in the larger degree is still being maintained. Okay, so as a momentum trader, you would just assume, of course, you never know at this point whether it's going to break or not. But you make an assumption as a momentum trader, you assume that it will not break because you assume that the trend will continue in the same direction. This is clear?
Yes, sir.
Okay. Now coming back to Sachin's question about the intraday trading. So I was talking about the 2 time frames, all right? And so I gave you 1 year and 3 months. That is just to introduce you to the idea of 2 time frames and just to give you a working framework. Okay, what should we take? Okay, let's take 1 year and 3 months. So nothing sacrosanct about it. And you can use any time frame that you need. And as Sachin has correctly highlighted, the particular duration of the project is so short that you will need 1 year and 3 months may not be sufficient. Okay, so you may want to use a shorter time frame. Let's say you use 1 month and 5 days. You can use even less than that. Okay, you can use even 5 day and 1 day. So your big picture could be 5 day. I'm just giving examples. Okay, your big picture could be 5 day, and your small picture could be. So if Sachin wants to do intraday trading, okay, which in equity markets is well known as, there's an expression you might have heard called day trading. Okay? Day trading essentially means that if we talk about, if you want to use, we are talking about DP4 solutions now, and we are, what is the thing that we discussed, 2 time frame, but I'm just using a new term. Day trading means very simple. 0 positions at end of every trading day. That's what day trading means. Very clear, very technical definition of day trading. Day trading means 0 position. So which means whatever you open during the opening of the market, you start with 0 position and you finish with 0 position. Okay? It's like what they say in the Gita, right? That you came into this world with nothing, and when you go, you will go with nothing. So day trading is a little bit like that. You start with 0 position and you end with 0 position. Okay, so be very careful if you are using, because in general in the market there is a tendency for people to use terms in very loose use of terms. So be careful, don't use terms like this in a loose way. Day trade, if you should only say day trading when you mean that your trading philosophy is such that you will always follow this rule. Okay, so I'm not writing beginning, because if end is 0, that means beginning has to be 0. Beginning of next day has to be 0. Okay, so such an is yes.
So it basically means stocks bought and sold at the same time, and at the end of the day, 0 stocks are there.
No, the first statement I don't agree with. Bought and sold at the same time. How can you buy and sell at the
same day, same day?
Don't say same time. Same time means 11.
No. Same day, sorry.
Same day. Yeah. So you buy it whenever you buy it during the day, that's fine. But before the end of the day, you have to close it out. All right. So that's day trading. All right. So coming back to Sachin's question, if he wants to do intraday, he wants to be a day trader. Okay, this we can write also as day trading, and this is also called intraday trading. So I will put this in brackets so that this is how you read it. So you can call it intraday trading. If you call it intraday, there should be a hyphen between intra and day. Okay, maybe I should put that hyphen here like this. Intraday trading, day trading or intraday trading. All right. So if Sachin wants to do that, so he can select his time frame, but I would say something, it's going to be more like maybe 5 days. 5 days is the big picture for him. Okay, and 1 day is the small picture. So on the big picture, 5 day, he sees there's a downtrend. Okay, and we are going to assume that Sachin is a momentum trader, let's say. Okay, and the big picture is a downtrend. And what is the small picture? The small picture is an uptrend actually, because the starting point is over here. So it's going up. So again, in this case, as a momentum trader, he can't do anything because his big picture is going down and his small picture is going up. All right. So so he can't do anything as a momentum trader. So this basic rule is clear. We'll just see it for one more. Example of let me just look at some other tickers. All right, so let's look at Wells Fargo, which are actually there in your Wells Fargo is a very profitable banking company. They've had some real scandals with their fake account opening and all that, like you had at the Airtel Payments Bank, I think. Okay. That was not as bad as the Wells Fargo, but yeah. So Wells Fargo, when I look at 1 year, and so Sachin, does that answer your question? regarding intraday. Let's look at intraday for Sachin. Let's look at Wells Fargo. 5-day, if we assume that it's a 5-day is the big picture. Here's the 5-day picture, and here's the 1-day picture. It's still not clear because actually I think this high is the highest high. So this is still down actually. I'm not sure. We have to do some actual reading of, it will take us time. I'm not going to get into that. But effectively what you have to find out is this the highest high or is this higher than that? Because that changes the decision. Because if these are the highest highs, then this is an uptrend. And small picture is uptrend and big picture is also uptrend. So then you would actually be a buyer, but we have to figure out. So it's not very clear, so we'll leave it. We'll take another stock. Let's take Morgan Stanley. So we're looking at the financials now, right? So please make sure you follow the market commentary also on the Bloomberg TV through the YouTube channel, because that will give you a good understanding of how people think about markets. For you guys, it's very important because you're pretty new in the markets. So you will have to learn to talk in that kind of lingo as well, right? So you better start listening to that. Just like babies learn to talk by listening to adults. So you need to start listening to these people, okay? So that you are at least able to talk in that kind of lingo and figure out what they're saying. So Morgan Stanley 5-day, okay, this is Morgan Stanley 5-day. Look, the trend is down, okay? What is 1 day? 1 day is also down. Now here Sachin can trade, as we are assuming that he's a momentum trader. What did we see? 5-day trend is down, okay, because highest point is made earlier than lowest point. So this is down. And now when we look at 1 day, that is also down mechanically. So so you can see here that the DP4 for Sachin has been solved. Okay, for intraday, DP4 has been solved. And so now what we do is in our bare bones trading system, remember in the bare bones trading system we are designing, we are talking about right now. So initially we will just design for you a minimalistic trading system. And once we do the minimalistic trading system, we will then go on to expand it further and look in detail at solving these two as well, entry price and the exit price with profit. But in the initial minimalistic trading system, we will not solve these. We will not bother to solve these because we will come up with a mechanical solution for entry price. So now that 4 is solved in a minimalistic trading system, how do we mechanically solve entry price? Here's what we do, okay? So let's look at this DP4. Trading system using TA. Let's look at. I'm going to come to the mean reversion solution of this, but let me first explain the momentum solution. Okay? Because remember, we have to also look at. This has to be corrected actually. One minute, just give me a time because I just copied it from momentum and I didn't. Trend on both time frames should not be contradictory. Right? Now, note that when it should not be contradictory means if they are same, like what you see in Morgan Stanley, big picture down, small picture down. Okay, I hope everybody is clear about this statement, which I'm going to write here so that you understand what I'm saying. Both we'll talk about this later. This is what I mean to say, okay? Now notice that in the case of mean reversion, we have written the rule slightly differently In the case of momentum, we are saying both have to point in the same direction, only then can you trade. So Morgan Stanley, we looked at Morgan Stanley, big picture down, small picture down, now I can trade, all right? But in the case of mean reversion, we are defining it slightly differently. We are saying that trend on both time frames should not be contradictory. Notice the language is slightly different, okay? Which means that you have, for instance, so what do I mean by should not be contradictory? First thing you have to understand is both time frames pointing in the same directions is included in the idea of this. When I say should not be contradictory, so here in Morgan Stanley, we can also say that the trend on two time frames are not contradicting each other because they are both pointing in the same direction. Okay, I hope this is clear to everyone. Okay, when they are pointing in the same direction, they are also fitting this different. But there's something more to this. There's a reason why I use this kind of language. Now, let's write it in a very, very stepwise direction. So we are getting a little bit lost because we were earlier we were going to go to discuss how, having decided Morgan Stanley, what Sachin will do in Morgan Stanley, he's going to be a seller. We were going to get into discussion of DP5, but before that, I just wanted to correct the text on mean reversion because I just copied it, and I wanted to make the rules very clear. Okay, how will you decide buy, sell, and is included? What else is included? Okay, so let's do very baby steps writing. I want to make sure that everything is understood because these are all very new ideas and complicated ideas, and you will not find them discussed like this anywhere else. Okay, so we want to make sure that everybody understands correctly. So we are using this kind of a very strange language that trend on both time frames should not be contradictory. Here we are saying and so the rule we are defining for mean reversion is slightly different. We are saying only then can you trade, right? For mean reversion. Okay, now what do I mean by this kind of strange language? Trained on both sides. So first thing to understand is that both time frames pointing in the same direction is included in this statement. Okay. Now what else is included in the idea of this here? Big picture. So here I'm answering this question. What else is included in this idea of this statement? Should not contradict each other. Big picture example. Okay, let's see. And then you can big picture down. Okay, or big picture up. Okay, and small picture. Big picture trend is equal to down or up, can be anything, and small picture trend is equal to neutralized. Okay, in the sense that all right, here what we say is that if you remember the discussion we had the other day about Procter and Gamble. Okay, what we had, if you have small picture trend. Okay, let's talk about trend. Is neutralized. What do I mean by this? Let's go back to our discussion of Procter and Gamble. So just one sec before that, Sachin, does that solve your problem you were talking about if you want to do intraday trading? If we use, does it solve the problem to some extent?
Yes, sir, mostly it is all.
Yeah. So as I said, now when I'm teaching you all these kinds of principles, some of the principles I will tell you are non-negotiable. That means you have to do exactly what I tell you. You have to follow exactly what I tell you to do. Like for instance, determining this, make sure you always have a stop in the market. These are very important principles. So here there is no negotiation and you should actually follow exactly what I say. But in certain areas, I want you, because by and large, I want you to evolve your own style. So in certain areas, you should feel free to experiment. And I'm only giving you a complete trading system as I practice it, just to give you something to use until you figure out your own method. Okay. So and that's why. So this is one of those things. Which two time frames to use? I only tell you to use at least two time frames, but I will not force you. Say, don't. I will not try to put pressure on you to use only 1 year and 3 months. I say that you figure out for yourself what you are comfortable with, but use two time frames. So in this case, Sachin may come up with 5 days and 1 day. That's fine. Somebody else may come up with 1 month and 5 days. That's also fine. Okay, you figure out what is okay for you. All right. So going back to this point, what we were saying. So what do I mean by, yeah, so we are just trying to understand this rule for mean reversion, which is trend on both time frames should not be contradictory. One thing we know that if they are pointing in the same direction, that means they are satisfying this rule. They are not contradictory. What else is included in this idea? Let's say big picture trend is up or down, but small picture trend is neutralized. Okay. Okay. What does that mean? Let's go back to the story of Procter & Gamble, which we looked at the other day. All right, Procter & Gamble, and then we looked at a different kind of two different trends actually. We looked at a 5-year trend where we saw that there is a very strong uptrend. Okay, so when you're looking at this kind of a chart, when you're zoomed, remember all the time, very important to remember when you're using charts, that at a point of time, don't focus on multiple zooms. Okay, so at this point, when you're looking at this kind of degree of chart, or this kind of chart, 5-year, this is a weekly chart, you only see low, high, low, high, low, high, low, and high. Don't start looking at this also, these ones, don't start looking at these when you're taking your decisions, okay? Then you'll get confused because this is more zoomed in, okay? This is more zoomed in. So maintain one level of zoom mentally in your mind. It's very difficult to do because as human beings, we are very visual creatures and it is natural for us to see all of the degrees of movement as far as possible in a very particular chart. But when you're doing your, when you're trying to apply a trading system, you have to be a little careful about this, okay? When you're using big picture, this is your big picture, then you don't start looking at all these, just use the big swings, okay? So when I look at this, I see, yeah, so what we are trying to show you an example of what it means, where, you know, where, what does it mean when you have the big picture is up or down and the small picture is neutralized, okay? So if we have a 5-year here, and then if we have, let's say, a 3-month here, all right? Now here, the 3-month is, we can say it used to be up, but there is a problem with this where we came to. This is the 1-hour chart. We're looking at this trend. Okay, this is the last low on the, this is, you can see, this is what we saw on the 5-year chart. Okay, this is the low. So if you focus on the movement from that low, you can see that there was an uptrend from here. But strictly speaking, that uptrend, when you're looking at 1-hour charts, I think most people will agree that you have low, low, these are the lows, here, 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 here. And then next one is pretty much all the way here, okay? And these are the highs, 1, 2, 3, and pretty much 4 here and 5, okay? I think most people would agree with that. Maybe a little bit of difference here and there, but generally you will find that this is a reasonably objective approach, okay? And what you find here is the small picture, the uptrend, well, it was there. There was an uptrend actually in the sense that, you know, the lowest price is lower than, is made earlier than the highest price. So you wouldn't want to go up. You want to go long here because big picture is up and small picture is also up. But there is a problem here because, yeah, I mean, yes, you would want to go up in terms of, this is what brings us to the DP5 part, okay? But here you see a problem because this uptrend has been neutralized, okay? because the sequence of higher lows has been broken. If you remember the minimum conditions for maintaining an uptrend, the lows must continue to be always higher than the previous low. And this low is now broken that condition because this low is not higher than the previous low. It is lower, so this uptrend is neutralized. So here what happens is, although you want to have a buying bias because the small picture view is also up, but it's not really a clean up because now you can see that has been neutralized, right? So what you do is here you would not enter. Okay, what you would not, as a momentum trader, you would not enter. But as a mean reversion trader, there will be a different view that we are coming to. But first, I'm just trying to explain to you what is meant by they are not contradicting each other, in the sense that here big picture was up, as you saw, 5-year big picture was up, but the small picture is not really clearly up because actually it's neutralized. Okay, it is up, it was up, but it's basically been neutralized. So that's what we are saying here, that big picture trend is down or up, can be anything. Small picture trend is neutralized. So if we have this kind of a situation, has everyone understood why in the case of PG, we are saying big picture trend here is, in the case of PG that we discussed right now, is big picture is up and small picture is neutralized because we see the sequence, this is a small picture, and sequence of higher lows now has been broken. So according to our rules, which we discussed,
Sir, if we technically see, sir, we have seen 6 months. Sir, it is 6-month graph.
yeah,
Hello?
this is showing 1 minute. One second, I'll just drink some water. 1 second. Which 6 months? This uptrend is starting from here, 14th May.
Yeah, sir. Sir, suppose, sir, it's a 6-month graph, no, sir, May to September.
What are you saying?
Sir, I'm saying that it's a short-term graph, no, sir, because it's a 5 months graph.
Okay.
If we have to see at the bigger picture, sir, we have to see at least 2 years or more than 1 year graph.
Yeah, but no, right now I'm only illustrating this statement that big picture trend is up or down and small picture trend is neutralized. And so for that discussion, I took this as the small picture, okay? And I showed you that this trend is neutralized because the sequence, although the direction of the trend is up or was up, but now the uptrend has been neutralized by the break below this. So your statement is correct. What you said, the statement is correct. That your statement, I agree. The statement is correct. That we have to look at big picture trends also. But at this point, I was just pointing out this thing that in the small picture, the uptrend has been neutralized. Is that part clear?
Yes, sir, because, sir, new support point is made, sir.
Yeah. Right now, there is no real, in a small sense, in this pattern, yes, there is a support. But the more important reason is, technically, the statement that you should make is that the sequence of higher lows has been broken.
Yes, sir.
We were continuing to see higher lows. This was higher, this the previous, higher than the previous. LT plus 1. See the condition in your notes. LT plus 1 was greater than LT for all these sequences.
Yes, sir. But in this case, sir, this lower is lower than
So
previous.
So this is the problem area. This is where we have the problem because the sequence is broken. So the uptrend is neutralized. So this is the kind of situation. So my question was, I hope everybody has understood what I mean by that. Here the uptrend is neutralized. And so I hope everybody has understood what I mean by this statement. Here's an example which we saw in the case of PG, where the big picture was up and the small picture has been neutralized. Okay. Is this point clear to everybody? The example I gave and what I mean by the statement? Okay. I hope everybody's clear. So if no question, then I assume that everybody has understood it. Okay. Now, what we are saying is, what else is included? So this is all.
Sir,
Yes.
sir, basically neutralized would mean that the up down trend that basically is going on, it will be somewhat in a line, somewhat in a straight kind of a line,
No, no.
around a straight like kind of a line.
So, Shaurya, you have to get used to talking in the strict theoretical terms that because we are teaching you a very specific kind of theory. These are very specific statements that have been made here. Minimum condition, if you're talking about neutralization, they have been giving minimum conditions are very clear. Okay. Up, down, up, down. This is basically what you should be saying. You're talking like a layman. Okay.
Yes.
And you're talking in lots of English language, and sometimes the meaning is not very precise. Okay, but we have given you a very clear theory. Okay, very clear theory. These are very specific statements. Okay, what are these? Condition for starting uptrend, condition for maintaining uptrend. Again, as I was correcting Rupal also earlier, that the statement that you have to make is you have to basically look out for this.
Low trend, current low trend, previous one, uptrend current, uptrend previous one, high trend and low trend, right?
Again, maybe you have understood, but your language is not satisfactory. Very simple. Let me just make it very clear to you. You don't have to think about it because this is theory, so you have to understand it in the correct way. Very simple. If you have an uptrend, okay, you have an uptrend, then, and as I said, for every trend, you have to lock into the degree of zoom. You have to specify what degree of zoom you're looking at. Here, I'm specifying, when I'm discussing this with all my students, I am telling them exactly what I am focusing on, what is my zoom level. Okay, I'm telling them that this is the zoom level I'm using. One low, one high, second low, second high. So they know that, okay, now everybody starts following. So once people have understood that this is the zoom level I'm looking at, high, low, low, next high. So immediately the students know that I'm not looking at this squiggly small, high, low, small, high, low. This I'm not looking at. They know because I said first high, second high. So, and first low, second low. So immediately they know which degree of movement I'm talking about. You understand what I'm saying, right?
Yes, sir.
So once I have clarified this to the students, then whoever's listening to me pretty much knows that in this zoom that I'm looking at, I think most people will agree that the lows are here, 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 and okay, some people might say here and all, but I would say just here and then here, and then we have a new low here, okay, which breaks the uptrend. So, and the highs are here. So everybody knows exactly what I'm looking at. And what you have to think about, don't confuse yourself with all that English language, just think visually. If you have an uptrend, okay, and you will have to identify the particular highs and lows in that uptrend so that then people will know what degree of zoom you're looking at, okay. Then in the uptrend, all you want to see is the lows, every low LT minus 1 here. What is the condition we gave you here?
LT plus 1 should be greater than LT.
In the case of an uptrend, LT plus 1 should be higher, greater than LT. Okay, very simple mathematical condition. Here you see this low is higher than this low is higher than this low is higher than this low was also higher than this. Okay,
Yes, sir.
are you following?
Yes, sir.
Okay, so that's all you need to know. Don't forget about all the other English language. You can abolish it from your head. Just think about, am I seeing an uptrend? Yes, pretty obvious. We have the low is made earlier than the high. Minimum price is made earlier than is marked earlier than the maximum price. So it's an uptrend, but is it an intact uptrend? The answer is no, because I see the sequence of higher lows, but oops, there's a problem here because this, now we have broken the sequence of higher lows because this low is lower than the previous low. So
LT plus 1 is less than LT. So hence neutralization has begun.
correct. Very good. Now you're talking in the right language. Okay, you have to talk because I've given you a very specific theory, so you have to now apply that theory, because if you start using all this English language, fuzzy language, you will get confused. Here you will not get confused. If you use this kind of precise approach, you will not get confused. As long as you first lock in the degree of zoom clearly in your own head, that you are not looking at. Why is it important to lock in? Because you make sure that you or anybody else listening to you is not looking at these smaller moves here like this. No, we are not interested in this. I'm only looking at up, down, up, down. That means high and high, low and low. So then you know what degree of zoom I have. Okay. Everybody is clear so far? Okay. Always look at this. Then if we go back to say Morgan Stanley and we look at what Sachin is looking at in the 1-day trend. Okay. What is he looking at? Downtrend. Okay. Very simple. What will be, so if we come back to what will be the stop, we can anticipate clearly. If Sachin goes
For
short.
a small doubt, sir. Small doubt.
Yeah.
We should not say like a current uptrend, previous uptrend, like that kind of a thing, right?
You're asking we should not say.
Like for this thing, should like we should not generally use it because it might get fuzzy a little bit.
Yeah. You just focus on using, see, when it comes to the theory, understanding the theory, I have written these notes in a very specific way, as you can see here when I'm talking and I'm trying to explain what do I mean. I'm writing it in a very precise way. You just try to follow when you're using the theory, when you're understanding the theory, you follow the language I've given you and don't take other language. The language I've given you is very precise, so you should try to follow that language. That will keep your thinking clear. Okay?
Okay, sir.
Okay. So in the case of, similarly, in the case of the Morgan Stanley downtrend, if Sachin wants to trade, his point that he's looking at essentially is either this or preferably this one is better. Okay. So this one is better. So this will be the point. If the price, now we are looking at a downtrend. Okay. So we take this downtrend as, I will define it, highs, highs, high, high. Okay, that's all I'm defining. Okay, so that means I'm not looking at this small movement here. Okay, that tells you. Then low, 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 and low. So now you know, everybody knows what degree of zoom I'm looking at. So immediately everybody knows that if they are following what I'm doing, let's say I'm a momentum trader and I enter always the DP5, which is the entry price. Using market order, limit order, stop order. Let's say I always use a market order. Then everybody knows that immediately I've got short at the current market. And everybody knows also that my stop will be here. Because I'm a momentum trader, my stop will be here. Because once the price rises above this is the critical point right now. Because the sequence of lower highs, remember this is the downtrend. So if you go back to your definitions, minimum condition for maintaining downtrend, HT plus 1 less than HT. Okay, so this is a mathematical way of writing it. You don't have to even remember it like that. You can come to the mathematics later. I would suggest always remember it visually, because that is the easiest thing to remember. Visually, very simple. Sequence of, in the case of a downtrend, first you draw the picture in your mind. Don't write the English first. Draw the picture in your mind. What is the downtrend? Lower highs. Subsequent highs are lower. Subsequent lows are lower. That's your downtrend. And the condition for maintaining the downtrend is these subsequent highs must be lower. So the moment you see this picture in Morgan Stanley, immediately you know that when I'm going short as a momentum trader, my stop is here. Because when the market goes above this stop, that condition of H, suppose there's a new high at 51. Okay, so the high at 51 is higher than HT. HT plus 1 will become higher than HT, and it has violated this condition. Okay, so it has broken the uptrend, right? So you know that your stop is also going to be here. So this is the clear situation. Okay, so is everyone clear so far? Okay, so now what we are saying is we are going back to this because I'm making sure I understand. I give you the two rules for the different how to use the 2 time frame approach. Okay. Now, okay, in this, okay, let me just see where I want to write this. I want to write the statement about this is the downtrend. Okay. This should actually go here. So the other thing I want to write is that I think I've written this somewhere, but okay, in the 2 time frame context, okay. So let me write this as an example, okay, just as an example, e.g. So this 1 year and 3 months I have used. This is just 1 year and 3 months. This is just for examples, as just as an example. So you can use any 2 time frames. Okay, obviously the long term has to be a bigger time frame than the small term, short term. Okay, so the point I want to emphasize here is that trading is always focused on the this is an important point that I've made this point earlier. I'm just writing it here right now. I've already mentioned it maybe a couple of times. The long-term pattern is used as a filter. Okay, let's call it a filter to ensure that you trade in the direction of the larger trend. Because remember that in general, we see very big trends in market in prices, as you saw in the case of, let's say, you can see even MSFT. I don't know how much data these guys have. So you can see here Microsoft. So you can see especially in stock markets and commodity markets, you get absolutely massive trends. Okay, huge trends, long-term trends. So it's very important to trade in the direction of the larger trend. If you see in the case of Microsoft, if you zoom in a little bit more, okay, you don't want to be caught in somewhere here going short, because actually the larger trend is still up. So the idea of trading in the direction of the larger trend is basically to make sure that you try to capture the big moves, and instead of trying to go short here, you would try to really look at the uptrend, look for buying opportunities by looking for short-term trend to turn up. Okay, so that's the basic idea. So the idea that I'm trying to mention here is that trading is always focused on the short-term pattern, okay, and the long-term pattern is as a filter to ensure that you trade in the direction of the larger trend. So that's why we do not allow you to trade. Why did I say that in the case of momentum? Why did I say even in the case of mean reversion, you will find the same filters apply? Okay, that why am I saying this? Only if trend on both time frames is trend, only then should you trade. Why? Because I don't want you to get swayed like this. If you go back to Ford Motor, now look at Ford Motor here. It's all turn, all yeah. So long-term trend is kind of almost neutral actually, although it's probably down because the lowest price here is actually here, and the highest price is made earlier than the lowest price. So it's not a good pattern. Okay, so that's why if you look at even 5 years, the trend is down. You just take 5 years as an example of a long term. I'm trying to show you this principle that I don't want you to trade against this point. How is the long-term filter working? The long-term filter is working to ensure that you trade in the direction of the larger trend. And let me make it more clear here. And not against it. Okay, so it is trying to prevent situations like this where you have Ford motor. Let me remove this now actually, I think, because one second, I'm just going to remove this chart to another screen. Right. Okay, so I want to avoid having you do things like this, that you have this long-term downtrend in Ford motor, but what you do is you look at maybe a 3-month chart and you see, wow, great, I've got an uptrend here, so let me go and buy. But you don't realize that the bigger picture is actually quite bearish. Okay, so that's what I want to avoid. So that's why we have this idea of the two filters. You will always be trading on the short-term pattern. So that means your stops and all are going to be set on the short-term patterns. Your entries, if you start to use limit orders, all the focus, the trading focus in terms of tactical trading decisions like stop and where's the entry price if you're using a limit order, all those will be based on the short-term pattern. So that is what I mean by trading is always focused on the short-term pattern. Okay, but the larger term pattern is a filter that is meant to avoid this kind of situation. So you don't want somebody to be going long Ford motor because he thinks, wow, great, let me see, oh, we have an uptrend here, let me go and buy. He should not do this because he should be mindful of the big picture, and the big picture is going down. So actually he should not trade. So that's basically the idea I'm trying to emphasize here, that trading is always focused on the short-term patterns. Okay. All right. Okay. Yeah. So what is the other point I was trying to make? Yeah, I was still on this point of trying to understand how mean reversion works. All right. How mean reversion works is, remember, as I said, trading is always focused on the short-term pattern. So if we go back to Procter and Gamble, PG. Okay. Now remember that for mean reversion, now we are trying to show you how a mean reversion trader will apply this use a trading system. Okay, the trading system we are discussing, because everybody may not want to trade as a momentum trader, because you may have your own, you may feel that you're more of a mean reversion player. But for mean reversion, what we have said is that you should still follow this guideline, that the trend on the 2 time frame should not be contradictory. Okay, so let's say you're looking at PG, okay, and you see the big picture is up, okay, but this is only a filter, and for mean reversion you can actually look at, so this is only a filter, but in the short term, if we look at, let's say, 3 months, all right, now let's say that you were looking at, yeah, let's say you were somewhere here, okay, let's say you're somewhere here as a mean reversion. Now you're a mean reversion trader. Now you see that the big picture is actually going, the big picture is going up. Okay, so here you can't actually, what is happening as a mean reversion trader basically is that you are, you are trying to go short. Because remember, as a mean reversion trader, you're second guessing the trend. Okay, you're always second guessing the trend, and so what you want to do is the idea of a mean reversion trader, as I said, as Siddharth asked a question, if you remember a couple of classes ago, a very good question about value investing, and brings out the whole idea of mean reversion and momentum. When you want to understand them, you have to always be talking about one particular zoom, okay, one particular zoom level. So here, as we said, the trading is always focused on the short-term pattern, small picture. All right. So anyway, what I'll do is I'll just take 2 minutes just before, I just finished the point about the mean reversion trader and what he will do. So because remember, the mean reversion trader is basically against the trend. Whenever he sees an uptrend, his first consideration is this uptrend is not going to last, it's going to turn down. That's his suspicion. Okay. And he sees a downtrend, he says, this downtrend is not going to last, it's going to turn around and start going up. So here he looks at this Procter & Gamble uptrend and he sees, and he says, no, this can't last, this has to start going down. But at this point, he can't go long, he should not be going short because there is no neutralization of this uptrend. Okay, there is an uptrend and it's not being neutralized. Okay, so he's not able to go, he should not go short. The only time he should go short, the earliest point where he can go short is when the uptrend is neutralized. Okay, so the uptrend is neutralized and then he can go short because now there's a better chance of it going down. So he, as a mean reversion trader also, you should wait for the uptrend to be neutralized. Okay, so I will have to reword the trend. Okay. So
I have a doubt at this point.
Yeah.
Sir,
I will just dismiss the class and whoever wants to, the class is dismissed. Okay, and then I will answer Vipul's question. So the rest of you can go. Those who want to leave can go. Okay. So I don't want to detain the whole class. I have detained you for extra 1 hour 30 minutes, 1 minute 30 seconds. Okay, yes, Vipul, go ahead with your question.
sir, like you are saying that the seller will or the investor will go short.
Yeah.
At this point, sir, but in my opinion, sir, if the price is below 135.18, which is the new low, if the price is below this point, only then the seller will go low. Because, sir, without breaking this point, we can't say that the share price will go down.
Yeah. So, no, which one are you talking about? Now, see, I'm just zooming in here. Okay.
Yes, sir.
What we said is that this was our small picture. Okay. This was our small picture, and I am a mean reversion trader. Okay, and let's say I am here. Okay, we are coming to Mitali later once I answer Vipul's question. Okay, now as I said, now I am talking like a mean reversion trader, and I'm trying to tell you if you're a mean reversion player, how you should operate. Okay, remember that as a mean reversion trader also your trading is focused always on the short-term pattern, the small picture, and you look at it as a mean reversion trader. What is your thinking? Your thinking always is that this uptrend can't last, it's going to go down and I want to go short. But you should not go short here because this uptrend has not yet been neutralized. So the earliest point where you can go short is when the uptrend is neutralized, which is when this thing breaks. This is the low actually, not this one, this is the low. And when this breaks, so somewhere around this point, when this breaks, when the previous low is broken, this is where is the earliest point where as a mean reversion trader, you should go short. Okay, or you can go short. Okay, so first people understand what I'm saying. Now,
okay, sir, at first place, we have to see where the earliest low is broken.
Now we are going to zoom into this point. Now, what are you saying?
Yes, sir. Sir, I am saying that suppose I am looking the graph from 8 September.
8 September.
September 8, sir.
Yeah, 8 September, yeah.
Yes, sir. Suppose, sir, I am a mean.
This low is 135.06.
Yes, sir.
Yeah.
So, sir, suppose I want to go short. So, sir, I will go short only when this point is break.
Okay, I understand what you're saying. Okay, so that is the second part we are coming. Let me do that in the next class. Okay, but I will tell you what it is. I understand what you're saying. I think you're talking about. See, there are two things happening. We are zooming into this point. Okay, there are two things happening here. One is.
Sir, I have a question, sir.
1 minute. Let me answer this question first.
Okay, sir.
Before that, we have Mitali also. Now, let's be clear about two things. What are we discussing? We are discussing about how a mean reversion trader will apply this technical trading system to solve the buy-sell bias, DP4. Okay, that's what we are discussing. So the mean reversion trader comes in, looks at the small picture. Let's say he looks at it here. And as a mean reversion trader, he is always suspicious of the current trend. He does not believe the current trend is going to last. Whatever is the current trend up, if it's up, he thinks no, it's going to turn around and go down. If it's down, he thinks no, it's going to turn around and go up. So he always wants to go against the trend. So here, ideally, he wants to go short, but he should not go short because the uptrend has not been neutralized. Okay, so the earliest point where he should go. So understand the points I'm making, then I'll answer the questions. So there are 2 points, 2 approaches for the mean reversion trader. The earliest point where he can go short is when the uptrend is neutralized, which is at this point, when this one breaks. As soon as this one breaks, he can go short. That's the first approach. That's the aggressive approach. Okay, that's one. Okay, I hope everybody is clear about this, that only when the uptrend is neutralized can you go short as a mean reversion trader. That's when you should go short. Okay, now, second point, there's another approach in mean reversion, which is the more conservative approach, okay, which I think is what Vipul is telling us about, which is that, now let's zoom into this part, okay? This is where the uptrend breaks, where the uptrend gets neutralized. Let's zoom in on this part. Now, 2 things are happening here, okay? Or 2 things can happen. One has already happened. The second thing can happen. That first, we had a long uptrend, which got neutralized around here when this thing broke. When the market broke below this, maybe on around 4th of September, okay, this low was broken. So the uptrend, the first thing that is happening is the uptrend is neutralized. That's the first thing. Okay, so that's the earliest opportunity for the mean reversion trader to go short. Now, the second thing that can happen, so this is the aggressive approach to mean reversion. Okay, let's put this down here so that we have mean reversion philosophy, entering the long short positions. Okay. Aggressive, okay, we're just writing a little bit, I'll refine it later. Wait for current trend to be neutralized before entering.
Sir, one small question, sir.
Yeah, 1 minute before entering position. Okay, so what I mean by this, what do I mean by this is what I just explained over here. Okay, that you don't go short over here at this point of August, of 3rd of August, because the uptrend has not been neutralized. If you want
yes,
to,
sir, according to you, sir, according to this point, sir, we will go short on 4th September.
yes,
when
yes,
it first breakdown.
Aggressive approach of mean
Yes,
reversion.
sir.
I will answer all the questions, but first I must answer the question. You have to listen to my answer to all the earlier questions. Okay. So what we are discussing, so we want to make sure that people are not getting confused and we are clear about what we are focusing on. How to implement mean reversion, okay, in this trading system. You see Procter & Gamble, big picture uptrend, small picture also uptrend, but you trade in the small picture always, and you are a mean reversion guy. So you see uptrend, you say, no, it has to turn around and go down, okay, because that's how the mean reversion guy thinks. So I tell you, what I tell you is, okay, fine, you want to go short, but don't do it right now. At least wait for the uptrend to be neutralized. That would be your, as Vipul has pointed out, 4th September, when the uptrend is neutralized. Okay, that's the aggressive mean reversion approach. Mean reversion philosophy, aggressive. Wait for current trend to be neutralized. Current trend means here, always small picture. We are talking about small picture because all the trading is focused on the small picture. Or wait for it to be neutralized, okay, before entering position. Now, I think what Vipul was talking about, so I'll answer Vipul first, then I'll go to Mitali and then to Saurya, okay. So what I think Vipul was talking about is, what Vipul is saying, oh, it's still not good enough for me to go short. Let's go back here. What Vipul is saying is still not good enough to go for me to go short. I should wait for what Vipul is saying actually is actually he wants this to break. Okay. And so what Vipul is saying is that, and I'll add a little bit to what I think he's saying. is that additionally, this high should not be, now from here, two things should happen. This high should not be broken. That means market can't go higher than this, should not go higher than this. And the market should break below this. Okay, let's zoom in.
Yes, sir.
Yeah. If I think, if I understood Vipul correctly, that's what he's
Yeah,
saying.
sir, this is what I am saying, sir.
Correct. So now Vipul is talking about second, the conservative mean reversion philosophy. Okay, conservative philosophy. Okay. Neutralized. Wait, conservative requires two conditions to be satisfied. Okay, wait for, no, 1 minute. The one should be here. Wait for, okay. So this has to be satisfied. So the aggressive position has, condition has to be satisfied plus, okay. Now before entering position will come later. Plus 2, 1 plus 2. New downtrend to develop. Okay. Now this example is for an uptrend. Obviously, when I'm writing theory, it should be very general terms. So obviously, you should not write it as a downtrend. New trend in the opposite direction. Okay. New trend in opposite direction. But I don't want to write it in down or up because that would mean that it's only on one side. New trend in opposite direction to be developed, to develop. Okay. What do I mean by this? I'll explain it very shortly. Vipul already knows visually what he wants. Okay. So what we are saying now, aggressive is as soon as this breaks, as a mean reversion trader, aggressive philosophy, immediately 4th September, you go short. Now, conservative approach to mean reversion is, that's not good enough, as Vipul is saying. Not only does the previous trend have to be neutralized, but I must also wait for a new downtrend to develop. We are discussing up, so I'm talking now about down, but if you were discussing down, then you would be talking about up. Okay, opposite direction basically. What Vipul is saying is, not good enough to just neutralize the previous uptrend. I should also have a new downtrend developing before I go short. That's also fine. That is just a conservative approach, okay? So what Vipul wants is after the neutralization of the previous uptrend, there should not be any new high should not be made, because if you make a new high, that means again uptrend is continuing, okay? So it spoils the whole thing for a mean reversion guy. So market should not go above this, and eventually market should fall below this. And you see why Vipul is saying I want to wait for a break below this to go short. Why? Because this is the point once this breaks. Okay, 135.06, low of 8th September. Once this breaks below 135.06, this is 135.06. Below 135.06, what do you have? Go back to your rules here. Minimum condition for starting downtrend. What is it? 2 highs and 2 lows. Second high is lower, second low is lower. You see that? If Vipul's condition is satisfied, then you will have a low lower than this one, 135.06. So let's say next low is 135. Then you have 134 or something. Let's say the next low immediately drops to 134. Now what do you have? You have 2 highs and it doesn't go higher than even this. So you have 2 highs. High 1, high 2, you had 1 low, and you now, as soon as you break below this, you have a second low lower than this. So you have condition for starting downtrend is satisfied. Is this clear? So this is what Vipul is saying. So this is what we would call the conservative approach to mean reversion.
Conservative reversion investors.
One is aggressive, one is conservative. Okay, because
Yes,
why do we call it aggressive? Because this guy is going with less confirmation, and Vipul is waiting for more confirmation. Okay, before entering position. Now you understand what I'm saying? Okay, now, okay, before we go to the other questions, is my answer to Vipul's question and my explanation of how to apply mean reversion in a trading system, is that clear to everybody? The two approach, make sure everybody understands. Aggressive.
Yes, sir.
Is that clear to everybody? Okay. Now, next, Mitali. Yes.
Sir, may I ask the question?
1 minute. Mitali had raised her hand. Is she
Sir,
there?
sir, yes, sir, yes, sir.
Okay, okay.
Sir, actually, my question is not related to this. I wanted to ask about the trading, which we have done yesterday. So you can first take short J question.
Okay. Okay. Fine. Okay. Sonia, what is your question?
Sir, my question is that does a momentum trader use that HT and HT plus one LT plus one formula, or is it only for the mean reversion person?
No. These are general formulae for assessing the condition, assessing the state of the trend. Okay. So this, when you're talking about, see, we have basically got two important things to look at. Okay. Minimum condition for starting uptrend, minimum condition. So basically, minimum condition are the 2 points. This, we are concerned with 4 conditions: uptrend, downtrend, starting, maintaining. Okay. This is clear, Shaurya? 4 conditions.
Yes, sir. These are the 5 conditions. Sir, go back to that page, sir. 1 minute, sir.
Where is 5? 4.
Okay. 4. Okay.
Why 5? 4. Uptrend, 1 minute. Minimum condition starting uptrend, minimum condition for starting downtrend. 2 conditions, correct?
Yes, sir.
Then you have minimum condition for maintaining uptrend, minimum condition for maintaining downtrend. Is this clear? Okay, as I said, do not memorize it using English language, using the English language. Look at it visually. Anytime you look at a trend, there is a sequence of higher highs, higher lows. We just discussed the conservative mean reversion approach. What does Vipul want to do? He wants to wait till new downtrend develops, which means he's going to wait. When will he get a new starting downtrend? Condition for starting downtrend: 2 lows, second low lower than the first, 2 highs, second high lower than the first. So once it breaks below this, that's why Vipul is saying that I will go short only when it breaks below this. Okay. So this is what you have to remember visually. When do you get a up? So first you remember basically that when you look at any uptrend or downtrend, you always see sequence of higher highs, higher lows. But now we define even more specific rules and conditions. We say, what is the earliest point when an uptrend starts? As we have low, high, or when you look at big picture movement, when you have big picture movement, you have low, high, low, higher low than this one, okay, high. And as soon as we have a new high, as soon as this high is broken, we have a new high, immediately we have 2 lows and 2 highs, okay, which the condition is satisfied, though the uptrend has started, okay. That's the first thing, condition for starting uptrend. You can flip it around and do it for downtrend. Practice it visually, okay. Do not try to remember the English language formula. Do that later. First, you practice it visually and understand it intuitively in your head, okay. That when you look at a trend, do these 3 things. You look at a trend, you see sequence of higher highs, higher lows in uptrend, lower highs, lower lows in a downtrend. Then think about what is the earliest point where you have an uptrend, okay, and what is the earliest point where you have a downtrend. Like here, Vipul is waiting for a downtrend to develop. He's waiting for a downtrend to develop before he wants to go short, before he will go short. So think about this. When does the earliest point where uptrends and downtrends start? And then think about this, that when do uptrends and downtrends get neutralized? Here, the uptrend gets neutralized as soon as the sequence of higher lows is broken. The downtrend gets neutralized when the sequence of lower highs is broken. Okay, as we saw in Morgan Stanley, 1-day Morgan Stanley chart, you see lower highs, lower highs, lower highs. If Sachin goes short, as soon as it goes above this, sequence of lower highs will get broken, will get destroyed. And the downtrend assumption is no longer valid because the downtrend is neutralized. Is this clear? Shaurya, you're clear now?
Yes, I'm somewhat clear, but I think according to me, I should look at the formula, then I should look at the chart, and then make it intuitive according to the chart, in my opinion.
That's fine. That's fine. Yeah, that's fine. You can look at the formula also, and you can understand. You can keep the formula in front of you, and then look at the chart and see why the formula makes sense. Because the formula also are very, very short and precise.
And moreover, one thing also, that a mean reversion person does his investing for a short term in general, whereas the momentum person does his investing for a long term, in general speaking.
No. This statement is not correct. This statement is not correct. Okay, we are coming to Vipul. First, we'll just check with Mithali once we are done with Shaurya. Yes, Shaurya, your statement is not correct. This momentum and mean reversion is a way of looking at charts. You can look at long-term data. Okay, you can. This is so many years from 1994, and you can look at 1 day also. It makes no difference whatsoever. Okay. Momentum mean reversion is a way of looking at charts and a way of deciding your trading bias. What you will find about momentum and mean reversion is, like, for instance, actually I suspect that Sachin is a mean reversion player. Okay, so you will find that whatever chart you show Sachin, he will come up with mean reversion type of strategies. So I mean, this is my suspicion. So I suspect that if this is the only chart available for Morgan Stanley, this is all we have, nothing else. Then if I show it to Sachin,
Then he will go up, because it will not stay on, keep going down.
yeah. So what I'm trying to say is that what I suspect is true is that once you identify somebody and you identify yourself that you're a mean reversion trader, you will find that Sachin, let's say if he's a mean reversion player, if I show him Morgan Stanley and this is the only chart we have, okay, he is going to say, if I ask him what should be your buy sell bias, he will say it should be buy, because he will say this has been going down for a long time, now it's going to turn around. Okay, so he's a mean reversion, so he will say buy. That is true. You will find that if you're a mean reversion guy, you will always be a mean reversion guy for every market, and the reverse is true also for momentum. But time frame has nothing to do with it. These are ways of looking at charts and deciding your trading bias, buy or sell, and it can be applied to all time frames. Everything, all the principles I'm teaching you are things which can be applied to all time frames. So get out of your head all these ideas that investing is for long term and speculation is for short term. These are all stupid statements that people in the industry make, and press, media, and all. These are all not precise statements. These are useless. You just forget about all this. You just learn what I'm teaching you. Okay. Clear, Shaurya?
Yes, sir.
Okay. You're done? Okay. Then we go to Mithali.
Yes, sir. Sir, actually, I wanted to ask two things. One is, if we buy or sell and we chose MKT, the market, so our share should be sell or buy at that point only, na?
Correct. If you choose, so this is bringing, now you should read, that means you have to read this note, DP5.
Yeah. So, sir, problem I was facing was, if I'm choosing MKT, the market, then also my share is not even buy or sell, not it was not working actually.
Did you transmit the order?
Yes, sir, I transmit the order, and due to which the share prices was getting in loss and I was losing more money. And when I logged in from my mobile, the price which were visible in the laptop and in the mobile were different, and also the price in the iPhone stock market app and the interactive brokers were also different.
No. What is the iPhone app for IB?
So there is an app which only where we can just put the tickers to check the up and down of the shares in iPhone, that stocks. So the prices in the
No, don't use that, because don't rely on that. IB,
okay.
IB,
But so then also the price, if I set the limit according to that iPhone app, then it got sell at that point. Matlab, it was yesterday it was showing 40.44, and I set my buy at 40.42 or 40 after seeing, and it get buy at that time only, and it was still showing 40.44, and it was increasing there. Matlab, there is no synchronization between that.
I'm not able to follow what is happening. First of all, I would say, see, what you have been given in interactive brokers, okay, I had
Yeah.
work for this. What you have been given is actually live data, okay? There is no delay. There's live data in your interactive brokers, at least in your desktop TWS. I don't know about the mobile apps of IB, okay?
Okay. Okay.
TWS, the data you have is no delay, okay? Unless your internet connection is there's some problem, there is no delay
Oh.
data, okay? So that is live data. So as far as your trading is concerned, you can use
Yeah.
that for even for other situations where you're somewhere away from your desktop. I would recommend you use the IB has smartphone apps also. Use the IB apps with your own login, okay? So that you should still get the correct data. Okay, don't worry about the iPhone app. Those are all, that is not going to be as good as your IB data.
Yeah, right, sir. But there was still a problem. Like if I said MKT, it wasn't it wasn't working actually. Then
Okay,
I have to buy and sell by setting limit price only.
first now, what you described to me seem to be, what you described to me seem to be like you're actually using limit. You need to read this document. This
Yes, sir. I have.
you're clear about this market order limit and stop order. You're clear.
Yes, yes, sir. Yes, sir. Yes, sir. I am.
Let's assume that at this point you do not use 5 point. Okay. Yeah, we'll come to Vipul. I'll have to finish with Vitali first. So let's assume that at this point, to keep it simple, you don't use 5.3. Okay.
Okay, sir. Yes, sir. So your voice is breaking, I guess.
No, no. There's some noise, background noise on your side. I have no background noise on my side. What stock
Sorry.
were you trading? Yes, Mitali. Hello.
Yes, yes, sir.
What stock were you trading?
Sir, I was trading on COP, and then on fast. The fast one was creating a lot of problem.
1 minute, 1 minute. Hey, 1 second. So COP is ConocoPhillips. Let's look at which is the one with those creating problems.
Sir, FAST, the fast one.
Okay. Fast and all. Okay. All right. So it was creating problems. So let's look at a short-term chart. Let's look at 5 minutes. Okay. All right. Now, what was the problem create? Now, let's put it this way. Now, let's say if you want to, let's say this is a downtrend here and you want to go short. Okay. Let's be clear about a few things first. Okay. Just make,
Yes, sir.
if you want to go short at the current market price, okay, then you use a market order. That means you want to go, the reason you use a market order is because you are so worried that it will drop like a stone right now. So you want to go short right now and you don't care about the price. Okay. Just do it, just sell it. Okay. Your attitude is that your view is so bearish. Your attitude is just sell it. I don't care about the price, a few cents here and there. Just sell it. Okay. Because it's going to drop like a stone right now. So that's when you use a market order, and a market order, you cannot know the price in advance. Okay. So
Okay, sir. Yes, sir.
in the case of market order, the system will tell you after it has executed your order, it will tell you it was done at this price. Okay.
Yes, sir. Yes.
But if you are particular and you say that, yeah, okay, I want to go short here, but I don't think it's going to drop straight away. I think it will come to 45 once and then drop, but it won't go above this. Okay. So in that case, now this is a different kind of view. So you have to form a view on the price action. Okay. So you have to then wait and see, in this case, you say that, okay, I don't think it's going to drop like a stone. I think it will move around a little, it will come to 45. So in this case, you place a limit sell order at 45. Okay, are you following?
Yes, sir. Yes, sir. I am.
So in this case, here you have a right. Here you have a right if you have placed a limit sell order at 45. Here you have a right to expect that your sell order will be done at 45, not at 44.50 or something, at 45, what you said, the price that you set. In a limit order, you have a right to expect it. In a market order, you cannot be guaranteed about the price. Now, I don't know what the problem you're facing. Maybe check.
Sir, can you tell me if we place market order, then how much time it will take to like it will take to just मतलब कितनी देर लगती है उनको applicable होने में, transmit होने में?
No, you have to. I hope you're transmitting the order, right?
Yes, sir. I am transmitting the order. After transmitting, how much time it will take for the order to get to get worked or to get sold or buy?
No guarantee on that. It depends on how many people are ahead of you. It's like you go
Okay,
to,
sir.
like,
Okay, sir.
you go to
Yes,
a,
yes.
and you stand at the end of the line. If the line is short, then they will serve you earlier. If the line is
Okay.
so in advance, you can't predict how long it's going to take.
Okay, sir. Okay.
So I
Thank
would,
you, sir.
1 minute, I would suggest that the Interactive Brokers website for the tutorials, and they also have a very good YouTube channel with lots of guides. Okay, and IB there, so you follow the official IB guides for using orders and placing orders, and make sure this. I'm not going to waste my time telling you how to do all this because
Yeah. Yes, sir. I know that.
okay,
Yes, sir. Thank you.
that this is just a procedure. Okay, like
Okay.
press that button. You read the videos, you figure out the procedure and make sure you follow. And what I will do is, here, my role is to basically teach you the theory here and know which order to use at what point and know the characteristics of the orders. Okay. So, yeah, Mitali, are you satisfied a little bit about what you're...
Yes, sir. I am.
Okay, good. You're done? Okay, now we can go to Vipul.
Yes, sir. Sir, my question is related to project. Suppose, sir, I am the only one who incurred the highest loss.
What? I could hear you. Related to what?
Sir, related to project work.
Okay, go ahead.
Sir, suppose I am the investor who incurred the highest loss and my position is last.
Yeah.
So, sir, how many marks I will get?
No, see, highest lot. No, that we have already explained once. Right? Go and read, go and watch the videos. But I'll just read.
Suppose, sir, investor is getting a profit of $3,000, and I am getting a loss of $10,000. So,
Yeah.
sir, I will get marks on the proportionate number of the highest investor, or I will get 0.
No. This I have explained 1 minute. I have already explained this. Maybe you were not there that day. You can check the video for that. But I'll explain it once again. It's very simple. We are going to, we should actually be putting this kind of a discussion into our calc file. I don't know where the calc file is. Yeah,
Yes, sir. You let us know that, sir. On that day, sir, you took an example. I know, sir. But, sir,
yeah. What happens is, one, if your trading is if your trading is this is not basically, but let's try and put it here. Okay. So if you, let's say you start with $100, okay, or let's say you start with $5,000, okay. Your starting is $5,000. Your ending is, let's say, $4,000. Okay. And this is one fellow, okay. And then let's say Varun has started with 5,000, and he has ended up with 7,500. Okay.
yes, sir.
Okay. Now this is not the only side. Remember, this is only the numerator part. Okay. So first we will calculate the period return. Okay. In this case. Okay. So in this case, the period return is 50%. Okay. And your
Yes, sir.
return is 20. Okay.
20%, minus 20%.
Now, what happened is,
This is
1 minute. Now, this is only now, as far as Varun is concerned, his return of 50% is only the numerator part. Now, I will also look at, that's why I have to take the daily data on your NAV. So we will look at we will also look at his drawdowns. Okay. So if you look at the drawdowns here, if you look at all-time data, maybe 5-year data, yeah. So you see here, imagine that this is actually a plot of Varun's NLV data from IB. We say instead of NAV, we say NLV in IB. Okay, but the general industry term is NAV. So imagine that this is not fast and all, but actually the plot of Varun's NAV. Every day we take a reading of his NLV figure from IB and we plot it, and we get this type of chart. So this is the return figure starting to ending. These two data points give you the return calculation. Okay, but this will also
yes, sir.
by the drawdown of the portfolio. I will look at the maximum drawdown. This is all the drawdown, another drawdown. Here it looks like we can't be sure. We have to calculate, but maybe this is the maximum drawdown. So the return will be divided by the maximum drawdown to calculate the raw score. Okay. In your case, because you have no return, your return is negative. Okay. I will also look at your drawdown. Okay. Because your minus 20% has not come in one day. All right. So we may look,
Yes, sir.
maybe your chart looks like this. Okay. Your chart looks like this. All right. So here we'll see, because your you may have actually lost in somewhere in between, you may have lost 40% and then come down, recovered a little bit and then come to, like if we take, let's say this month, like 1 year. Yeah. So you see that you have actually gone down, but you went down almost to this point, and then you recovered a little bit and ending is a little bit higher. So essentially what I will do is look at your total return, okay, your CAGR return on the numerator, and denominator I'll take the drawdown, okay. So it will basically be CAGR, okay, return numerator, max drawdown is the denominator. Okay. So now in this case, when you have a negative return, okay, then I will take the greater of the two negatives. Okay. This is always by definition, the second one is always negative. Okay, this is always negative by definition. Okay. So
Okay, sir.
but I'll take the greater of the two negatives. And in this case, where he has got a positive return, and deflate this, obviously, this is the absolute value of this drawdown will be taken and deflated. And we will see what, because we want to make sure that if he makes a high return, if he's also taking very high, if he has got very high drawdown, then that's a negative factor.
Okay. And sir, suppose a scenario is like that, sir. Suppose the investor on the first day lost 50% of its capital,
Yeah.
and at the end of the project he recovered all the capital, but not any profit. Like
Yeah, so
NLV sir, at the end is 5,000 only, not 4,000 or
No,
not anything else.
1 minute. In that case, the same rule applies. In that case, your numerator is 0
Okay, sir.
and drawdown is 50%, maximum drawdown. So in this case, I'll take your raw score to be minus 50%.
Okay, sir.
Okay. So, and then in this case, and eventually I will line up all the scores, and then I will take the raw score, and then I will create a ranking of students, and then I will assign a grade for the top student, a percentage score. Suppose I give the top student 80%, and then I will give the bottom student some arbitrary grade, maybe 30% or something. And then in between, everybody will get pro rata with marks.
Okay, sir.
So you have to also understand that your drawdown you may actually make so say Khushbu can make a lower return than Varun, but her raw score may be higher because her drawdown may be less. So
Yeah,
what?
sir. Yes, sir. So now I understand. Suppose Varun makes a profit of 2,500, but his drawdown is 8,000
Yeah.
at some point.
So we are interested in just the return. We are interested in the return divided by the drawdown. So it is actually, that's why we call it a risk adjusted return. Okay, so the term that we use is risk adjusted return. That means we are not interested only in return. We are interested in your risk adjusted return. Is this clear?
Yes, sir. Now it is clear, sir.
Yeah. So this is good that you have clarity. But in general, I would say just use the project as an opportunity to learn about trading.
Sir, actually, sir, I am facing problem because shifting from Indian market to US market is, sir, something different.
Why
I'm
is it?
experiencing now.
It should not be different because the concepts are the same. Maybe because what has happened in the Indian market is we are not a very international kind of conventions are not followed and all that. So you forget.
Yes, sir.
So you forget about all the whatever you learned in the Indian market. You follow the theory that I'm teaching you now.
Yes, sir. Now I'm following, sir. I'm following technical analysis basically. Sir,
If you learn your theory according to the based on the focused on the US market, you can always apply it to the Indian market, but the reverse is not true.
yes, sir. So the first problem is that, sir, I am applying the reverse strategy.
If you're a test player, you can play Ranji Trophy, but the reverse is not true.
Yes, sir.
Okay. So that's what. So that is it. Is this clear?
Yes, sir. So,
Any other questions?
no, sir. Sir, but sir, I joined late because, sir, there is a power cut. Sir, so, sir, this is what I want to clear.
Guys have generally join on time. All right. Okay.
Sir,
So
because, sir, I live in different cities, sir, not in Delhi. And, sir, here the situation is different.
where are you?
Sir, I am in Sonipat.
Oh, you are in Sonipat. That's the Sonipat situation.
Yes, sir.
Fine. Okay, guys. Okay, so then no more questions. Should I stop the recording?
Yes, sir.
Okay, fine. And no more questions for anybody. I'm stopping the recording and I will end the class. Okay.